Shares of quick service restaurant or QSR players have been under pressure for some time now. Over the past 6 months, related stocks like Devyani International, Jubilant Foodworks, Restaurant Brands Asia and Sapphire Foods have tumbled up to 26% as against about 0.5% rise in the S&P BSE Sensex. So what has led to this deep underperformance in the QSR space? Analysts underline margin pressure emanating from higher raw material prices and weak purchasing power of consumers amid elevated inflation as key concerns.
The key reason for underperformance of the QSR players in the last few quarters, as per our understanding, is first, slowdown in overall SSG growth due to cut down in discretionary spends and weak consumer sentiments on account of high inflation. Second, reduction in the new hiring from the IT and startup companies, where customer from this segment has larger demand for QSR product, has seen the overall slowdown in demand. Third, easing of the COVID-led pent-up demand, where QSR player had seen a strong growth in the last 2 years due to high pent-up demand. So all these factors is resulting into slowdown for the overall SSG growth. And the second reason for underperformance of the QSR player is due to pressure on the margins on account of high raw material prices, particularly in the dairy, where the cheese prices has reached an all-time high, coupled with aggressive store expansion by most QSR players, has added further woes to the overall performance of the QSR players.
Earlier, in the October to December quarter of FY23, not only did the QSR players see negative to lower single-digit same-store sales growth due to moderation in consumption post-festive season, aggregate EBITDA margins too continued their downgrade trajectory on a year-on-year basis on the back of inflation in agri-commodities and dairy products. Going ahead, analysts expect QSR companies to extend their dismal performance in the January to March quarter of FY23 as well. Here's why.
QSR companies are likely to continue with their poor performance in Q4 as well, while sales growth is expected to be strong at around 20% on a YoY basis, led by aggressive store expansions and a lower base. But lower SSG and continued material cost pressures is likely to keep the EBITDA growth subdued.
That said, analysts expect the financial position to turn around over the medium to long term as inflation ebbs. From an investment perspective, Poddar of Motilal Oswal recommends using this correction to accumulate related stocks for the long term.
We believe that demand might revive from here with the onset of the holiday season and with the inflation stabilizing. Thus, from a long-term perspective, we believe one can use this correction to accumulate these QSR stocks as a long-term opportunity. QSR, with their strong brands, present a great investment case given their low penetration levels in India. We like Devyani International, given KFC's strong brand equity and its growth opportunities, the gradual turnaround that is being witnessed in the Pizza Hut, and along with this, the network expansion across the portfolio and the healthy operating profitability makes us bullish on this company.
Overall, though QSR stocks are expected to witness near-term challenges, analysts expect concerns to gradually fade away in the long term. As regards today, Q4 results, rupee movement, oil prices and global cues will continue to sway market movements.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.